All right, today we're going to tackle something every single one of us has thought about as an investor, that temptation to time the market. Is it really the secret to making a ton of money, or is it just a trap? Well, let's dig in and find out.
I mean, you see it every day, right? The market goes up, the market goes down. It feels like this giant, unpredictable pendulum. And the real question, the one we're all asking, is how do you actually profit from those swings, instead of just getting tossed around by them?
So here's what we've got on tap. We're going to start with the big dilemma every investor faces. Then we'll dive into the two big ideas, timing versus pricing. We'll look at why we're so drawn to forecasts, check out a famous formula that just completely fell apart, and then see what the more powerful alternative looks like. And of course, we'll wrap it all up with a key takeaway for you.
Okay, let's jump right into it. The investor's dilemma. I mean, with the market always moving, what are you supposed to do? What's the smart play here? Well, it really comes down to a choice between two very different paths.
And make no mistake, this choice is a big deal. Whether you go down the road of timing or the road of pricing, that decision is going to shape everything. Your whole strategy, how you think about investing, and yeah, the results you get. They're two totally different ways of looking at the same puzzle.
So what's the difference really? Let's get into the nitty-gritty of timing versus pricing.
And the difference is pretty stark when you lay it out. Timing, well, that's basically you trying to be a fortune teller, right? You're trying to guess what the market's going to do next. But pricing? That's totally different. That's about being a detective in the here and now. You figure out what a stock is actually worth, and then you wait to buy it when it's selling for a discount.
The person who lives and breathes by timing, we call them a speculator. And for them, it's all about speed. They're not playing the long game. They want to get in, get their profit, and get out fast. The idea of waiting around for a year, the source material literally says it's repugnant to them. It's all about impatience, and honestly, that's a tough game to win.
Now, on the complete flip side, you have the intelligent investor. They're all about pricing. Because their whole focus is on buying a great business for a good price, waiting doesn't bother them one bit. Seriously, if the price is right, the time doesn't really matter. For them, patience isn't something to endure, it's their secret weapon.
Okay, so if pricing seems like the more solid path, why are we all so obsessed with timing? What is it about predicting the future that's just so irresistible?
I mean, think about it. You can't escape it. Turn on the TV, scroll through your phone, there's always some expert telling you where the market is headed. But if it's so hard to get right, why do we listen so closely? Why do we care so much?
Well, it really boils down to two big psychological reasons. First, we feel like we should have an opinion on the future, It makes us sound smart at a dinner party. And second, it's just easier to trust an expert. We think, hey, their guess has got to be better than mine, even when there's no proof of that. It's a mental shortcut, but man, it can be an expensive one.
And it's funny, this quote really nails it. This whole culture of forecasting, it's thickest on Wall Street. The closer you get to the center of the financial world, the more people believe they can predict the future. But the farther you get away from that bubble, the more people you find who are, let's say, a little more skeptical. So let's look at a case study, a story about a formula's rise and spectacular fall. We're talking about the famous Dow theory. At one point, people thought this thing was bulletproof. It's a perfect cautionary tale.
So here's how it worked in a nutshell. If the market broke through a previous high point, that was your signal to buy. If it dropped below a previous low, that was your signal to sell. Seemed pretty straightforward, right? A totally mechanical system, no emotion involved. What could go wrong?
Well, for a while, nothing did. The results were absolutely incredible. It gave a sell signal just a month before the huge crash in 1929. Then it flashed by right near the bottom in 1933. I mean, people thought this was the holy grail of investing. But then, around 1938, things started to change, radically. For the next 3 decades, the theory performed so poorly that you would have made more money just buying stocks and holding on to them. The magic, it turned out, was completely gone.
So, what happened? Why did this perfect system just stop working? Well, there are 2 big reasons. First, the world changes. Markets evolve, and a formula from one era doesn't necessarily work in the next. But the second reason is the really interesting one. The theory basically became a victim of its own success. Once everyone started following the same buy and sell signals, it warped the market's behavior, and the formula just lost its predictive power.
And all of this brings us right back to our alternative. If formulas and forecasts eventually lead you to a dead end, what's the path that actually works? Well, it's the simple, reliable power of pricing.
And here's the absolute key to understanding this. Think about it. What good is it to get a buy signal if the stock is already way too expensive? The only reason timing would ever be useful is if it helped you buy something for a cheaper price. So at the end of the day, timing is useless unless it serves good pricing.
The pricing approach, on the other hand, is just beautifully simple. Step 1, figure out what a business is actually worth. Step 2, buy it for less than that. Step 3, sell it if it gets way above that value. And the golden rule, the one you can never, ever break, don't pay too much. That's it. It's about discipline, not trying to predict the future.
And you know what? There's a huge psychological benefit here. The moment you stop asking, when should I buy, and you start asking, what price should I pay, all that stress, all that anxiety about timing the market perfectly, it just disappears. You're not a slave to the news ticker anymore. You're in control.
All right, let's wrap this up. What's the one big idea, the foundational takeaway you should leave with today?
It's this, and this quote says it perfectly. There is just no good reason, logically or based on past experience, to believe that a typical investor can successfully guess what the market's going to do. It's a game you're almost guaranteed to lose over the long run.
So real success in investing doesn't come from predicting the future. It comes from knowing what you're doing in the present. And that means paying the right price. Your power isn't in some magical forecast. It's in your own discipline right here, right now. So, at the end of the day, it all comes down to one crucial question you have to ask yourself. Are you trying to be an investor or are you trying to be a speculator? Your answer changes everything.